Your coffee shop survived its first month, and then your phone rings. It's the bank, and they want one thing. Prove it. Where every dollar came from, where it went. You open your notebook and it says, money came in, money went out. That's not bookkeeping. That's a fortune cookie. This is Chapter 2, Fast. One tool, 500 years old, and it looks like the letter T. Stay to the end. The whole chapter fits on one card you can screenshot. Word of the day. An account, an individual accounting record of the increases and decreases in a specific asset, liability, or owner's equity item. Baby version, an account is one page in the shop's diary. One page for cash, one page for equipment, one page for revenue. Anything that moves gets a page of its own. Here's what a page looks like, and it's called a T account because it looks like the letter T. 3 parts, that's the whole anatomy. 1. The title, the account's name, written on top. 2. The left side, called the debit side. 3. The right side, called the credit side. Now forget everything scary you've heard about those words. Debit means left, credit means right. No good, no bad, just left and right. The left side of this slide is your own work. Maple Beans cash, exactly how Chapter 1 taught you. Plus 10,000, your investment. Minus 6,000, the machine. Minus 300, supplies. Plus 4,000, sales. Plus 1,000, the loan. Adds to 8,700. Now the right side, the same 5 moves folded into a T. Every plus goes left, every minus right. Debits 15,000, credits 6,300. And the difference is called the balance, 8,700, debit side, because debits won. Now flip it. Accounts payable, the shop's promises, straight from your month. You owed $600 for supplies, $450 for the grinder, $400 for the ad bill, and you paid $600 back. This page is a liability, so the signs flip sides. The increases live on the right. The one decrease moves left. Credits $1,450, debits $600, balance $850, credit side this time, because credits won. And that number should look familiar. It's the accounts payable your Chapter 1 balance sheet reported. So who grows on which side? Here's the map, and you read it like directions, not vocabulary. Assets equal liabilities plus capital minus drawings plus revenues minus expenses. Chapter 1's own equation, opened up, and every term carries a sign plus or minus. That sign alone decides its rule. Assets sit on the left of the equal sign, so assets grow on the left, the debit side. Same word, same side. Liabilities and capital carry plus signs on the right, so they grow on the right, and revenues carry a plus too, so they grow on the right as well. Then the troublemakers. Drawings and expenses are equity too, but their minus signs flip the rule. Notice what just happened. Assets, drawings, and expenses landed on the debit side. Liabilities, owner's capital, and revenue landed on the credit side. Put them together, dealer. One caution, that E is owner's capital specifically. Drawings and expenses are equity too, but their minus signs push them across, exactly as the map showed. You didn't memorize that, you derived it. And that side has a name the exam wants. An account's normal balance is simply the side it grows on. And here's the part exams love, what each of those does to equity. Owner's capital, the money you put in, pushes equity up. Revenue, what you earn, pushes equity up. Expenses, what you consume, pull equity down. Drawings, what you take out, pull equity down. That's my favorite tip in accounting, and it's why the minus terms grow on the debit side. They are the equity shrinkers. Expense up, equity down. Revenue up, equity up. For these 6 derived slowly, we made a whole separate video, linked below. Now watch the map work. 2 steps, every time, forever. Chapter 1 left you with $120 of espresso cups on account. Step 1 is pure. Chapter 1, what moved? Supplies up, accounts payable up. Step 2, read the map. Supplies is an asset going up, and assets grow by debits. So debit supplies. Accounts payable is a liability going up, so credit it. 2 lines and last chapter's homework is closed. Chapter 1 tells you what moved. The map tells you which side. That is the entire game. And the famous name from Chapter 1 now gets its full title, the double entry system. Every transaction is recorded in at least 2 accounts, and total debits must always equal total credits. Money never appears from nowhere and never vanishes into nowhere. That's why the books can always be checked, and why the bank gets its answer. Which leaves one question: how do we write all this down, day after day, without losing our minds? with a 3-step assembly line, and it runs the same in every company on Earth, from Maple Bean to Apple. Step 1. Analyze. Real companies never analyze from memory. They analyze documents, a receipt, a check, a bill. Step 2. Journalize. Write the entry in a book called the journal. Step 3. Post. Copy it into each account's own T inside the ledger. Analyze, journalize, post. 2 of those are new, so let's meet them. The journal is the book of original entry because every transaction lands here first, in date order, a diary, and the format has strict manners, kept for 500 years. The date goes in the left column. The account to be debited is written first, at the margin. The account to be credited goes on the next line, indented to the right, always. Why? So anyone can read a journal at a glance. Flush left means debit. Indented means credit. One example, because one word here needs it. Transaction 3, the compound one. 900 of supplies, 300 in cash, 600 on account. Supplies up 900, debit. Cash down 300, credit. And the unpaid 600 is a new promise. Credit accounts payable. 3 accounts in one entry. And the debits still equal the credits. Transaction 4, a week of sales, 4,000 cash. Cash up, debit. You gave up effort, not an asset, so it's revenue. Every other entry works like these, and the full lecture walks all 13. Step 3, needs a destination. The ledger. If the journal is the diary sorted by date, the ledger is the binder sorted by account, in the order of the expanded equation. And here's the connection that makes it easy. Every page in that binder is a T account, the exact T you already own. In real offices, the page wears a different costume, date, debit, credit, and a running balance, like a bank statement, same left and right, dressed for work. Now posting, a procedure, not a mystery. 3 moves every single time. Move 1. Find the account on the journal's debit line and enter the date and amount on the left of its page. Move 2. Find the credit line's account and enter it on the right of its page. Move 3. Write the ledger page number back in the journal's reference column, which is how you prove it was posted. Now watch it on your own first entry. Debit cash 10,000, cash page, left. Credit owner's capital, that page, right. Entry 2. Equipment left, cash right. Do that for all 13 entries, and the board fills like a scoreboard. Draw the line under every page and let each T announce its balance. Cash, 17,000 in, 8,900 out. Balance 8,100. Supplies, 900. Equipment, 6,450. Receivables, in and out, 0. The page closed itself. Accounts payable, 850. The number you met earlier. Notes payable, capital, drawings, service revenue. And the expenses. Every page now holds its truth. The inspection is called the trial balance, a list of every account and its balance at one moment, built straight from the entries you wrote. Debit column, cash 8,100, supplies 900, equipment 6,450, drawings 200, and the 4 expenses. Total debits, 17,850. Credit column, payables, capital, revenue. Total credits the same, a perfect match. And notice who's missing, accounts receivable, the page that closed at 0, so it has nothing to report. Why do accountants love this page? 3 reasons. 1. It proves total debits equal total credits, the heartbeat of double entry. 2. It helps uncover errors, because if the columns disagree, you know to go hunting. 3. It's the required first step toward the financial statements you met in Chapter 1. No trial balance, no income statement. Now the warning, and exams love it. A trial balance can balance and still be wrong. 4 sneaky cases, a transaction never journalized at all, a correct entry never posted, an entry posted twice, or the right amounts pushed through the wrong accounts. In every one, debits still equal credits, the columns match, and the error hides. Baby version, the trial balance checks that the scale is level, not that you weighed the right things. So how do you fix a wrong account? Say the 450 grinder was debited to supplies instead of equipment. Add the 2 columns and the column still balanced, but supplies now reads 1,350 when the shelf only ever held 900. There are 2 ways to fix it. Method 1, the eraser. 2 entries, reverse the wrong one completely, then write the correct one. And the full lecture works, that through step by step. Method 2, the 1 move way. And it's the elegant one. Accounts payable was never wrong, so leave it alone. The 450 is simply on the wrong page, so debit equipment, credit supplies, and both pages are back to the truth. Same ending either way. And never scribble over an entry, the audit trail is sacred. And how do companies stop wrong account mistakes before they happen? A chart of accounts, the ledger's table of contents, a numbered menu of every account the company uses. Maple Bean puts assets in the 100s, liabilities the 200s, equity the 3, revenues the 4, expenses the 5. See the gaps? On purpose, so new accounts slot in as the shop grows. And this is not a trial balance, which students mix up on every exam. The chart is the menu, names and numbers, no dollar amounts. The trial balance is the snapshot, real balances, one date. Zoom out, you've earned the view. Everything accountants do. Every period follows one loop. The accounting cycle, 9 steps. Analyze, journalize, post, trial balance. Look where you're standing. You've already done all 4. The entire recording half conquered. What's left? Adjusting entries and the adjusted trial balance. That's Chapter 3, where we make the books tell the truth. The statements from Chapter 1. Closing entries in 4, and the post-closing trial balance that resets the loop. Screenshot this, the whole of Chapter 2 on one card. The T, title on top, debit left, credit right. The map read straight off the expanded equation. Double entry, debits always equal credits. The pipeline, analyze, journalize, post. And the trial balance, a matching test that cannot see a missing entry, a doubled entry, or the right amount on the wrong page, with its one-move repair beside it. Point your phone at the code and the printable version opens. Free. Chapter 1 gave you the equation. This chapter gave you the machine that records it. One last thing, your trial balance matches to the penny, and some of its numbers are already lying. The books say supplies, 900. Walk to the closet and count. There's less. You've been pulling cups and beans off that shelf all month. Who's right? The books or the closet? That's Chapter 3. This was the fast pass. For all 13 transactions worked slowly, the full lecture is right here. And the free notes, exercises, and mock exams are at appliedanalyst.com. Future CPA, I'll see you in Chapter 3.